Alright guys, welcome back for another installment of the Da Vinci program again today. Um yeah, today's probably one that you're really gonna want to get involved in, and this is the module on blocks and breakers. So what are they? How do we use them? Like, you might hear me guys talk about blocks and breakers a lot, and this is like the number one entry requirement I have. Like I only have two entry requirements. And that's either a breaker setup or a block setup. And usually for intraday trading, I'll use breakers quite a lot, just because they're a lot better. You can get a better risk reward with them. They're more efficient really. And usually with intraday, because there's quite a lot of market structure breaks, price won't always retrace very deeply into a range. So that's why you can get really good entries on a 5 minute and a 15 minute with breakers. But yeah, today's just about understanding what they are, how they work, why they work, and when to look for each kind of setup also, guys, because it's knowing when to look for what setup and why also. So, first of all, let's just go over like what a block is. We'll do blocks first because blocks are probably the most important ones, like concept-wise. So, a block, guys, is more or less what it really is it's a support or a resistance level. Okay, they're forms of dynamic support and resistance levels, and they're just essentially levels where price can pivot from, and they're levels that we use to get entries where price will pivot from. Okay, guys. So a bearish block, right? In this situation, because we're looking at the bearish future price action at the moment, is the last up candle before any substantial down move. And what I mean by that is usually if we're looking for a block setup, we want to see the last up candle, right, before a low was taken out. So in this situation, this low was the last real up candle, right? The last significant up candle near the high where a low was taken out. Okay, so once that low was taken out, if we want to get short again, that is the area that I want to get short at. And a major thing, guys, to remember is that usually when you're using blocks for entries, you want to see the block that is nearest the structure high or structure low that you are looking to get an entry from. So in this situation, because that was the last structure high, like if I want to get short again, like the way the market moves, the market will move when it's bearish or when it's trending. It will move in measure moves, right? And what that means is basically price will take out a structure low, it will create one price leg, and then we'll see price create another equal price leg or something similar to the last price leg it actually created. So in this situation, guys, like you want to be using the block that is closest to the structure high or the structure low. So in this situation, this would be the block I'll be using. Why? Because this is the last up candle before that down move. Okay, guys. And because that was the situation, like once price took out that low, that's where it retraced to. Because, and this, the way to really understand this concept is to understand, your swing high and your ranges, because understanding where price is in the range, whether it's in discount, whether it's in premium, like that will also help you understand what blocks to use. But really and truly, the block is just the last up candle before the down move. I mean, we can use a similar concept here. In this situation, guys, we have a block here. This is the one that I'd want to use. Like if I was really going to be using the block, guys, I want to be using this one. Why? Because it's the last up candle before that down move. But price didn't return to that block. It returned to that one there. Okay, but it's the same concept, guys. It's the last up candle before that down move. Let's go to another example. Let's go on the bullish side now. So a bullish block, guys, is the same thing. It's just on the opposite side. Okay, so this is a really good example because we've got quite a nice expansion up, right? So in this situation, I'll be using the last down candle, right, before the up move. Now, when we get very small candles like this, right, I mean, yes, we can use them. But what you'll find is that the market won't always return to those levels because it's such a small price point. What it will tend to do is, if we get a block, right, that it looks a bit more beefier, I will tend to use that one instead of that one. And the reason for that is because there was more buying in that block than there was in this one. And this will lead me on to explaining to you guys like how these blocks really work and why they work. So the principle behind them is that when the market makers are moving price around the market, whether it be up to take liquidity or below to take liquidity, guys, their positions are massive. All right, when they go into the market, they have very, very large pockets, and they have extremely, extremely large accounts. They're dealing with billions and billions and billions of pounds on any transaction alone. So when you see a price action like this, it may look quite small, but that's a lot of money going into the market at one time. So basically, the market makers, they have to average in on their trades. They cannot just enter the market and buy the same way we do, because they are the liquidity in the market. So if they try to buy when prices are moving, or if they're trying to buy up here, the market would just fly. It would fly because they have way too much liquidity in, to actually be able to buy like that. They're the ones that are moving the market. So if they're buying heavily. So the principle, guys, is that they buy when the market is dropping. Okay? When the market is dropping like this, that is when they are buying, because what they're doing is they're averaging in to their position. So they're buying all the way down. From that high, all the way down to the low, they are buying. And then that's when they finish buying, that's when the market just flies off in the other direction. Takes that liquidity above that high, and so on and so on. So, in other words, guys, the reason why we're using blocks is because what we are doing is we're using the last price point, right, that the market makers bought from. And that's why you'll see the market return to these areas, because when the market makers want to buy more, they're very great. They're greedy just as much as us. They don't want to be buying at premium prices. Okay, they want to be buying at prices where it is very, very close to the last price point that they bought at. So when you see the market expand like that and it returns, the reason why it returns and it wicks into that level, because it doesn't really hang about at that level. It just wicks down. What they're doing is they're averaging in. So they're buying at the last price point they're buying at, because they want to get the best price. They want to buy as close to the last price they bought at, because that just means their profit margins are a lot wider once price starts expanding to the upside and fitting in other people's orders. Okay, guys? So that is why when you see price return to these levels, you get an expansion to the upside quite rapidly. And that's why these levels are magnets. That's why we use these levels to buy from, and we don't put our, because I know a lot of retail traders will literally just put their buy stops above the market. And the reason why that's bad, because sometimes you get false breaks, but a lot of the time price won't move that far from that previous high. Obviously in this situation you did get quite an expansive move up, but you want to be buying at the safest point to buy it, and that's more or less when the market makers are buying. Okay, guys, so all we're really doing is just following in their footsteps, and the way to do it is to buy from the price points that they buy from. And this is the indication. Okay, this is what's allowing us to understand where the last point they bought at. This is the closest we're really going to get on the platforms that we're using, because obviously, they segment price, and the furthest price goes down, the more segmented it gets. So by the time you get, your price, your charting software from your broker, right, they're going to have manipulated it and then a whole load of stuff. So this is the closest we can really get to understanding where the market makers bought at. And then obviously that will still give us a good opportunity to buy from. So this is what we are framing. This is what we are framing everything on, guys. All right, we're framing it on understanding when they bought last, and then copying that same action, so that we can get in on when they get in on the trades. And then what we can do is we can ride price up, and then obviously get out at the safest point, which is at those highs. So this is why we use blocks, guys. It's the same thing with the sell. All right, it's exactly the same on the sell side of it. That is the last point that they sold at, because what they were doing is when price was rising, what they're doing, they are selling. And that's why you see price expand from that point, because that's the last point they sold at. Same thing here, when price retraces back to that level, what are they doing? They're adding on to their position, guys. They're compounding. The market makers are they're always averaging in, and they're always hedging in and out of their position. So what they're doing here is that once price gets back up to that point, that's the safest point for them to buy it, to sell at, sorry, because that's the last point they sold at. So that's the best price they're going to get. And that's why you see price pull back into that block, and then you see an expansion to the downside. Okay, guys, this is the reason behind it. It's the same thing. If we're going to be using this level here, that's the last up candle before that very, very small down move, not much of one. But price is just literally putting back into that block again, and then we see expansion again, putting back into the block again, expansion. Even here, putting back into this block here, last minor up candle before that down move, before those lows were taken out. Price pulls back into that range. Boom, you see an expansion down. Okay, guys, it's the same phenomenon that happens again and again and again and again. But this is the reason behind it. They're using this because that is the best price point they can get in. It's all about money, guys. All right, this whole game is just about understanding, how money's moved around the market and how to best position yourself to make the most of the money that is in the market. And that's what they're doing. They know that they can get a better price up there. They know that's the last price point that they sold at. So what they're going to do, they're going to take price back up to that point and sell again. Because they move the market. So they more or less can choose when they're going to sell and when they can get the best, best prices. So that's what they're doing, guys. And it's understanding that framework that's going to allow you to actually make money in the market and not get your arse handed to you as much as you would do. Like, I still get my arse handed to me every single day, and not every single day, a lot less now, a lot less. But you're still going to be wrong. But this understanding these concepts will allow you to have the framework to be right in what you're doing. So it's the same thing we're doing here, guys. Yeah, we're just understanding where the block is, capitalizing on once price reaches that block. Because this is a 4-hour chart, so you can set a limit there and get a crazy entry, put your stop below there, and target a high, and boom, you're out by the time price takes out a high. And yes, I do know that there's an elephant in the room, which is, yes, price did do a good number of pips after it took out that high, but this is where you must be disciplined, guys. Okay, have your targets. I mean, you could have had that as your target, and then you could have had that as your target and got out here. But being disciplined is extremely important, guys. All right. So just make sure you keep that in your brain. But yeah, this is just the formation I'm using. Okay, guys. Breakers, blocks are they're where we want to buy, and bearish blocks are where we want to sell. Okay, and it's always the last up candle before price continues downwards. But something that helps me find out what block is going to hold is usually what I'll do is I'll say, okay, if we're in this range, I will have that'll be the block that I want price to come to, but I will also have that in mind. So in this situation, what I see, guys, is I'll wait for price to show me what block it wants to capitalize on. And the way I'll do this, if we're on a 4-hour chart, I'll mark out that block, and what I'll do is I'll scale down to the hourly or 15-minute, and I'll look at the price action around that block. Okay, I look to see what price is doing around that area. And if, for example, if we're in this situation, once we get price come up to a level, it kind of like shows some exhaustion in the market, kind of like just mediates and pulls back again, then I'll be selling at that point, because it's most likely this level is most likely going to hold, because we don't see much more buying pressure to continue to that block there. So understanding what block is going to hold, guys, is more or less just understanding really the candles and understanding when the market is going to be exhausted, or understanding where price is coming into. If price comes into that and it starts consolidating, or you start seeing very small candles and contractions, that's indicating that they're accumulating at that price, and that it also indicates that that block is also going to hold. So when you see that, guys, then boom, you can go for a sell. But it's the same thing here, guys, that we see same formation even on the hourly chart. On the sell position there, boom, expansion down. Okay, guys, it's always the same setup we're looking for, nothing different. All right, even the same thing here. Price broke that low, continue lower. What did it do? Retrace back into that range, back into this block here again. The last up candle before that down move, and what did we see? We saw price start consolidating. See, so we saw very, very small contraction points, and then we saw an expansion down. All right, guys. So yeah, that's the key with blocks. All right, it's just understanding where they are and understanding how they're being used and why they're being used. And it's all just to do with money, guys. All they're doing is using these levels to buy from and sell from, so that they can make more money in the market and have less risk. Okay, it's always about minimizing your risk and trying to maximize the money you can make. But this stuff is all scaled on the same idea that money is what moves the market, and understanding where it is and using these blocks as pivot points to reach those goals. That's what's going to allow you to get far, guys. Okay. Now, we've talked a bit about blocks, but breakers are also something that people do forget about. And I didn't use breakers for a long time in my own trading, guys, but breakers are more or less just blocks that have their roles switched. That's the best way to really understand it, because I think a lot of people confused. I have certain, obviously I have more than just that. I'm just showing you on a very, very basic level. They are more or less just blocks that have their roles switched around. So instead of a bullish breaker being a support level, it's now a resistance level. Instead of a bearish block being a resistance level, it's now a support level. Okay, guys. So if we go back down to a 4-hour chart, I can better show you this. So here is a breaker on a 4-hour chart now. Okay, guys. So what I mean by that is that in a normal situation, once price breaks that low, what we really want to see is for price to pull back into this block here, and we want to see it being used as a resistance level, right? We want to see price pull back into that range and then seek lower prices. However, in this situation, what's actually happened here is that it's basically its role has been reversed. So instead of seeing it use that level as resistance, we see it now use that level as support. So what it's done is that it's broken above that breaker now. It's closed above that breaker. And a good way to understand whether a breaker is going to hold, guys, is if you see a candle close above the breaker, it doesn't really need to close above the high. If you see the candle close above that breaker, that indicates that it's going to be, it's going to be used as a support level. So a breaker to me is a bearish block that has had its roles reversed. And the way that I would know a breaker is that I want to see that breaker or that block, I want to see that breaker being used to run a significant low. Alright, guys, so what you want to see in the market is you want to see the block or the breaker used to run a low, take liquidity from a low. In this example, that's the low that we're talking about, and we want to see price get above it and use it as support. And the reason why it works like this, guys, is because it's the same liquidity concept. Once price takes out a low, that objective is met the objective of the market, right? So what it's done is that the market makers have sold at that point there, all right? They sold inside that candle there to take the liquidity out of the market at that point, at that price point. So, if they want to take prices higher, what they got to do first is they got to neutralize all the sell positions that they had there. And the reason why they got to neutralize it, guys, is because they don't want to be in a deficit, right? You've got to realize that these banks are very, very greedy. They don't want to be in a deficit. Okay, they don't want to be holding sell positions while the market is moving up. So what they'll do is that they'll push price to take out those lows there and fulfill in their buy orders that they have, all right? Because there'll be a lot of people that want to sell at that point, so they're pushing price below that low there to sell, so they can pair up their buy orders with that sell position there. And what they'll do is they will want to mitigate that. So once they're long at the market there, because what they'll do is they'll get long underneath those lows in this situation. That's why you see price break below that low and come up. So what they're doing is they're now long the market here. So if they're now long and they have sell positions, they don't want to be holding those sell positions through that whole move there. So what they'll do is they will neutralize that sell position by letting the market break above and then retesting that block. So all the sell positions they had in that block there, they are neutralizing them now. That's why you see price spike down and rise up. It's neutralizing it. It's fulfilling those orders in. So what they're doing is they're now buying at that level, and they're buying those positions back from where they were selling them. And that's why you see a massive expansion after. I mean, look at that 4-hour candle. It's a nice big juicy candle, right? It's expanded to the upside. So, what they're doing is they're scaling in. Okay, guys. So that's why these levels work, because it's all structured. It's all based on liquidity and how the market makers use price and move price between certain levels. Okay. So in this situation, guys, you see price break above that, see it retest it, and then you see an expansion to the upside. So a breaker is more or less a bearish block, guys, that has been used to take liquidity from a low or a high. In this situation, it's a bearish block is one that's been used to take liquidity from a low, and it's now being used as support. Okay, guys. So if we're going to go, let's go and find a bullish example of this now, because we have bearish breakers and we have bullish breakers. That's what I kind of call them, just to give them names because it's a lot easier to understand. So if I'm looking for a bullish breaker, guys, what I'm going to be looking for also is I want to see a bullish block that has run liquidity on the upside and is now being used as support on the downside, right? So I'm going to go and find one for you now, just to make this a bit easier for you. Okay, let's look for a good price point to use. Alright, that's not the best one, guys, but we'll start with this one. So we have a very, very small block here. Why? It's the last up candle before a down move, but what's happened here is that price is now broken below this level here, guys, okay? So what we're seeing here now is we're seeing price break below that low, and it's now being used, that block there is now being used as resistance, see? So what price has done is it's dropped right below that low now, it's taking liquidity from that low, and it's now being used as resistance. And there you can see, guys, that level right there is being used as a resistance level. Okay, so the reason why this is the breaker is because it's taken out that very, very intermediate high there. Okay, I know it's a small high, guys, but same concept we're using here. Okay, this stuff just works by defining what this stuff is. You've got to have a definition of this stuff, because you won't always see the perfect setups, but what you will see is the same conditions, guys, and it's all about the conditions in the market. So a breaker is basically a bullish block that is run liquidity on the upside on the market, which is right there, and once price gets below it, it's now being used as resistance, guys. Okay, it's now being used as resistance. Why? Because they were long that market, and their long positions, they want to now neutralize them. And the way they're going to do that is by dropping price below that and retesting the same area they bought from, which was that block. Okay, guys, it's the same thing that we were talking about on the bearish block, except this time we're using it in bearish market conditions instead of bullish market conditions over here. To go long, here we use it as bullish market conditions, boom, to go long. And over here now we're using it as bearish market conditions. We're using this as a bearish setup to go short. So let's say you couldn't get short, because obviously in this situation there was no short entry here, right, guys? I mean, there was no real retracement, OTE retracement. We didn't get like a break at low and a return to that block. We literally just got price consolidate and just expanded down, and we would not get an entry. So in this situation, we missed the shorting opportunity that we had, or that we missed a short opportunity here. There was no entry for us. So in this situation, what we can do is that we can use breakers as an opportunity to get in on that short, and that's what we're doing here, guys. So what I'd have marked out is I'd have that breaker marked out, and as you can see, once price starts retesting it, that's where I'll take a short. I'll take a short inside this area and put my stop above the breaker. Alright, guys, and then you can capitalize on that downward move. So this is how you would use it to get an entry, guys. You would use it once price has taken out a high and it's now broken below it. The key here is that we want to see price use that level to take out a high on the upside, and once price breaks below it, then we want to be seeing that same level being used as resistance, guys. It's the same support and resistance concept that you'd understand from from traditional support and resistance, but this time we're using candles as dynamic support and resistance instead of lows and highs. Okay, guys, we're just using the candles instead now, but it's the same concept. Nothing's really changed. And as you can see here, guys, that same level was again used as resistance right there. Once price came back up to it and it sold off, took out those lows there. Alright, guys, so it's the same concept we're using. Nothing different. Now, what I want to show you here, guys, is another way you could use breakers to get an entry. If we draw that out here, why is that a breaker? Because it's the last up candle that's taken out stops below that low here. Alright, guys, boom, took out stops liquidity out there. Now the price got above it, we want to use that as support. Simple as that, guys. Yeah, you're just seeing price use that point to take out a low, and then all you're doing is waiting for it to rise above that level and use it as support. And that's what's happened here, guys. Yeah, so we've seen price come to the EQ of that block, and then we saw it find and look for higher prices. Alright, guys, now how can we use this again? Let's find another example. I wouldn't necessarily use this example here, guys, but you could do. And the reason why I'm saying that is because, let me just see something. Which account am I logging into? Okay, so if we draw that level out there, why is that a breaker? Why? Because it's the last up candle that took out that low there. Okay, guys, So what we're seeing here, we're seeing price drop below that low. What's it done? It's risen above it now. We saw it break and close above that level, it dropped back into the range, but now what's it being used as? Now we can use that level as an area of support. Boom. And that level, that breaker also lines up with this block. So when you get a breaker, guys, or a block inside a breaker like this, that's a very, very powerful level. And look, it's also at a whole level, guys. It's at a full figure level. So this would have been a perfect trade for you guys to take, because you already know that these institutional levels are important, and you've also got a breaker inside or block inside a breaker. Boom, beautiful move up to the upside, and look, liquidity was taken out of the top of the market. Okay, guys, so just go through your charts to understand this. I think breakers are a lot more difficult to see. If you're having issues with them, just please let me know. But they are. Don't worry if you don't get them at first, because they are quite difficult to understand, especially when you first start. But understanding blocks, right? You want to just, if you can only understand blocks in a moment, then stick with all the blocks, because blocks make a lot of sense. It's just a simple retracement back into the range, and you can use it to capitalize on. Okay, but breakers are a lot more difficult to understand, but it will come a time, guys. All this stuff, I can show you this stuff, but it's just practice. Okay, it's just simply going through your charts and looking to see where they are. But I think understanding blocks are a lot easier to see, because you can literally just draw them out. We've got one here. There's a block there. We've also got another one here that was used to capitalize on, and that was the same one we're talking about inside that breaker. We've got another block here. Boom, price came into it again. We got one here. Okay, so all blocks are just a last down candle before that move. All right, guys. We have another one there again. Price took out that high. It also took out that high. Dropped back into the range. Okay, guys. So just go through your charts and study these. But they will get easier, and you will start to understand them better when you see them. But yeah. All right, guys. See you soon.